Welcome to Sustainability Bridges, a Eurosif podcast that aims to build bridges between policymakers, investors, academics and civil society around the theme of sustainable investment. Eurosif, the European Sustainable Investment Forum, is the leading pan-European association promoting sustainable finance and investment at the European level. In these podcasts, Eurosif's Executive Director invites distinguished guests for a 30-minute conversation on current events shaping the sustainable investment community.
Hello, ladies and gentlemen. My name is Aleksandra Palinska, and I am the Executive Director of Eurosif, the European Sustainable Investment Forum. For this episode of Sustainability Bridges, I'm delighted to welcome two guests, Nathalie Dogniez, who is the chair of Eurosif, an independent director sitting on the boards of funds, fund managers, and non-profit organizations. Nathalie has over 30 years of experience within the financial sector and has spent over 20 years focusing on ESG and sustainable finance. Our second guest is Matt Christensen, the global head of sustainable and impact investing within Allianz Global Investors. Matt is responsible for accelerating the different aspects of sustainable finance and impact investing across the company. He has been working on advancing sustainable investments and impact finance for over 20 years. Matt is also a member of the Eurosif board. Nathalie, Matt, thank you for joining us today. Today, we would like to take stock of the impact of sustainability-related investments on financial markets and the real economy, especially in the context of the current regulatory and political headwinds. We would like to discuss the positive impact of the EU sustainable finance rules. Eurosif has recently published a report where we have compiled evidence and research demonstrating that sustainable finance contributes to positive economic and financial outcomes. And we thought it could be useful to discuss its key takeaways, as well as to hear your feedback based on your rich experience. As an introduction, could you both share your opinion on the state of sustainable finance today? Is there appetite from investors still there? And what are the latest trends in this space?
So what I can say is in my, let's say, meeting with clients over these past 3 to 5 years, the biggest difference that I see from, let's say, now versus 2021, 2022 is that to some degree, what I would call the investor client that were more like tourists, that is, they're more experimenting and sort of felt they had to do something, there are fewer of those. But what has remained is a core client base and even an improving maturation and sophistication from those that were already involved in the area of sustainable investing, and that they're asking better questions over these last years than they did previously. And so I find that the richness of discussion with our clients anyway has improved. But no, I'm not seeing as many. So there's a trade between what were sort of lower level, not such interesting client questions, but more of them, to a deeper level, but maybe a narrower band of clients. But for me, that they've been here and they're still going to put more and more money in as they go up the chain of learning, which has always been the case, I find, with clients on sustainable investing.
I would say it's true to say that sustainable investment has moved from being the topic of the month, the things that everybody was talking about, into, I would say, a sound practice in terms of managing long-term risk. And I would say long-term investor keeps a strong focus towards long-term consideration, long-term risk, including sustainability risk. An investor remains very focused towards investing in transition and renewable energy, for instance.
Maybe just as a kind of a follow-up question to you, Matt, looking actually at the figures in terms of the assets managed by Allianz Global Investors, would you say that in terms of the volumes, you have seen an increase of sustainability-related investments over the years?
So certainly in what I would call the bull market of sustainability, meaning that zone from 2018 to 2022, yes. And that was a mix of new money, but also conversions of funds, like most of the industry, by the way, in Europe. And subsequently, what we've seen is it has slowed down. We're still increasing the assets under management on a yearly basis, but at a much more what I would think of as a normal clip, not at that exponential growth that you consider. Those happen in market cycles and then they fade away. But what has remained the same is that there's still a growth that is happening over time.
Now, Nathalie, turning over to you. What are the benefits of sustainable finance for economic growth and value creation?
Sustainability considerations are increasingly embedded in investment decision and fund strategies. I mean, across all strategies, not only sustainable investment or transition investment. For instance, let's take two companies, Company A, Company B, both in the same sector, both having similar or comparable profitability. But Company A has deployed a sustainability strategy and has massively invested in the transition. A smart investor will recognize that Company A is better prepared for the future, whereas Company B is expected to deploy expensive capex in the future to avoid having some part of its activity being stranded, or just to keep up with the increasing fossil fuel cost or the new regulation emerging. So this is why a smart investor will be choosing Company A versus Company B. And this is also why ESG risks are increasingly integrated in mainstream investment for risk management and longer-term value creation. A recent study from Morningstar that we quote in our report, The Voice of the Asset Owner Survey Quantitative Analysis, says that 60% of European asset owners consider that ESG is becoming increasingly material for their investment. And 61% believe ESG consideration contribute to fulfilling their fiduciary duty towards clients. So sustainable finance is a business value proposition. It is a driver of growth and competitiveness. It is mobilizing finance for a just transition to a resilient and low carbon or carbon neutral economy. It's important to realize that competitiveness is not just about cutting costs right now. It's also making sure you do the right investment, forward-looking investment that will make you ready for the future.
Turning over to you, Matt. The report underscores resilience as a new productivity metric. How does sustainable finance contribute to effective risk management for investors and companies? And more globally, how does it help Europe manage structural and geopolitical risks?
So resilience, it's the word of our time. Resilience and adaptation, if I could even say two words. But let's just talk about resilience. So the idea of resilience is the ability to withstand and adapt to financial climate and geopolitical risks. And certainly in our clients, that is a question that keeps coming up, which is how are you making companies, this is where our investor clients ask, how are you making companies more resilient to become better at dealing with the competitiveness that is surrounding them? And as we're now during the week of the World Economic Forum, it's happening this week, the WEF estimates losses due to climate change at $3.6 trillion since the year 2000, and that it could amount to up to 20% of the global GDP by 2100. So the whole notion of a delayed transition is not without its cost problems and certainly a profitability to that is European companies, what they predict to be around 2 to 3 percentage points by 2030. So all that to say, sustainability factors are financially material considerations that affect performance and risk for investors. The resilience idea connects the macroeconomic stability to firm level performance. It is that capacity to absorb the climate, geopolitical, financial, and operational shocks without eroding long-term value.
Now I have a question to both of you, Nathalie and Matt. The evolution of sustainable finance as a market practice has been supported by the European regulatory framework on sustainable finance. Several of these EU rules are focusing on transparency, standards, and data availability. For instance, Corporate Sustainability Reporting Directive, so-called CSRD, as well as its accompanying European Sustainability Reporting Standards, SFDR, so the Sustainable Finance Disclosure Regulation, as well as the EU Taxonomy. The report identifies these EU rules as key building blocks of sustainable finance. Why are they so important for investors as well as for companies?
Well, clear definition like the taxonomy, SFDR, and comparable disclosure on investee company like CSRD help investors distinguish genuinely sustainable activities and investment from greenwashing. So these definition and standards improve trust and help investors make their capital allocation decision, which in turn enable companies to get finance at a lower cost. But if we look at the corporates, the business also, you could say there is great advantage as well, because in business, you can only manage what you can measure. So all companies that have implemented CSRD concur to say that it was a very healthy exercise, helping them identifying risk and opportunities and measuring medium to long-term risk and opportunities. It also supports board strategic decision and investment for the future.
If I could just add a few thoughts to that, Alexandra. So I agree that these are building blocks. They are necessary for helping the market to better calibrate and understand the what's often been the missing link, data, and having a data that's comparable. What I would say, though, is that it's also there's room for continuing to think through how much of that data, how much transparency do we need as a market? And I think that's a lot of what I see in sustainable finance. The question of today is a little bit about how to make it so that you have the basics done very well and then some optionality on how much further you might go in reporting.
One of the key findings of the Eurosif recent report is that EU sustainable finance rules are already delivering and have positive impact on the transparency of companies and their ability to attract capital, as well as, in general, helping mobilize finance for a just transition. Would you agree with that statement? And if yes, could you provide some examples?
So many companies are already integrating sustainability into core strategy and capital allocation. They are rewarded for it. Studies show that transparency helps companies to access finance. Let's take the example of a very useful tool, which is the EU Taxonomy. In 2024, the average EU Taxonomy aligned turnover of EU companies with activities covered by its criteria was 11.2%, totaling 825 billion euro. The taxonomy should not only be seen as an alignment of turnover at a point T, but it should also be seen as a tool to track sustainable investment. So the taxonomy's strong uptake is demonstrated by a 22.7 average alignment of EU companies' capex, showing that companies use the taxonomy as a tool, a guidance for a significant part of their forward-looking investment and growth strategy. Another example is the fact that ECB recognized that companies with credible transition plan enjoy a valuation premium. Companies that are aligned with climate target are perceived as presenting a lower credit risk by financial market participants, which entails a facilitated access to financing.
Maybe I can offer a view as well, Alexandra. So I tend to like this idea about the green bond market. Green bond market's been an interesting case study. So I've had a lot of experience working with the green bond market. And what we can see is that green bonds are often oversubscribed, and there is a greenium allowing cheaper capital for the issuers aligned with sustainability. The question has often been about, are investors getting a good deal for that, or are the companies getting a good deal? And so I think that's an ongoing discussion. But what we can say is that the green bond market has been a market of growth. And part of that is the idea of having this notion of a verifiable system about what is a green bond, how that companies therefore have to make it transparent about the use of proceeds, and then the idea of attracting capital because of that. It's not just your normal bond. And what I would just say in finishing is that corporate green bond issuers accounted for more than 12% of the EU's total corporate bond market, and that's doubled in size compared to 2020. So these are great examples about setting the right type of rules, setting the right type of incentive structures to encourage the growth of sustainable finance.
What role do EU rules, standards, and labels, like for instance SFDR, so the Sustainable Finance Disclosure Regulation, which is currently being reformed, the EU Green Bond Standards, as well as climate benchmarks, play in directing capital?
So I always say that I think we are better off with regulation. And then I always say, but regulation has to be tested until it gets to the point where we think it's the right trade on the work to adhere to it and the capital flows that we want from it. So what I would say is that all these standards, these rules, these labels, they work as signaling tools. They're helping capital flow to sustainable activities, mobilize finance in order to accelerate the economic transition to a sustainable economy. The labels should give investors confidence and credibility as well as the comparability. I really do believe that this will support European companies in attracting capital both here domestically in the European market, but also international capital outside. And so just as some examples, in 2024, 100 billion euros in assets were managed in accordance with the EU climate benchmark criteria. I talked about Green Bond. The EU Green Bond Standard launched strongly in 2025 with robust investor appetite, driving over 11 billion euros in corporate issuances. So SFDR, these types of regimes, they're good at starting to help improve transparency on sustainability considerations. What I think is the improvement to come is to help make it that much clearer about the standards we expect to adhere within the SFDR regulation, which I think was quite wide. And I'm hoping that in these next years to come, there's a narrower set of understanding to make the rules clear for all stakeholders.
The report underlines that regulatory stability is important and that frequent regulatory changes, even if meant at simplifying rules, are burdensome. Could you share your views on that?
Frequent rules changes create confusion, undermine trust, and create cost, given that companies and investors need to adjust the system already put in place for compliance. Frequent regulatory change also make long-term planning difficult. As an example, the Omnibus Directive, rolling back core requirements of CSRD, taxonomy, and CSDD obligation, was initially conceived as a simplification measure to ease administrative pressure. But however, its rational focus on the short-term cost of implementing these rules without considering the long-term benefit of supporting business and investment towards future sustainability and resilience. These abrupt changes created the complexity it sought to reduce. Companies and investors that have already complied with the initial rules and deadlines now face the ambiguity about the changed scope and substance of the rules and standards. So in fact, you could say that EU has always enjoyed or benefited from the stability of its political and regulatory background. And it just took one omnibus directive to undermine the credibility built over decades. Indeed, by penalizing the enthusiastic first mover, Omnibus has created a climate of distrust towards EU regulatory initiatives. So, because significant rollback to disclosure rules are disrupting investor plans to leverage ESG data that would have helped them improve their analysis of risk and opportunities, as we have just discussed.
Thank you, Nathalie. Matt, would you like to react to that as well?
I agree with the idea that we do not want rules to change too frequently. I totally support that view. I do think that the regulation was slightly overburdening, but I'd rather have it than not have it. So I think I'm still waiting to see what we'll end up with. And I support much of what Eurosif has said in terms of the need to keep stability, the need for there to be a reach that goes further than what is being currently proposed. But I also appreciate some simplification might benefit a large group of actors.
I would maybe slightly disagree, Matt, because the Omnibus Directive did not address the simplification. The simplification was addressed by the simplification of the ESRS, so the level 2 implementing measure. So we could have achieved simplification by only changing the level 2 measure without significantly reducing the scope and ambition of CSRD that has been achieved by the Omnibus Directive and by rolling back transition plan implementation in CSDD.
And I think that's the good debate to see what comes out of this whole thing. I appreciate that point of view. She might be right. I don't know yet.
Surely, and I think maybe that is the topic for our next podcast interview, kind of providing, a debrief of what has been actually agreed just before Christmas last year in the context of Omnibus 1 initiative. Indeed, I think maybe going slightly beyond my moderator role in here is, I think, a lot of debate has been that has that been indeed a true simplification or rather deregulation disguised as intended simplification. One thing that actually also makes me often wonder why in particular only sustainability and sustainable finance rules have been addressed by the simplification. In my former jobs, I've been working on a variety of EU rules which are way overly complex, like market abuse regulation and directive, prospectus regulation, and so many other rules, not mentioning financial reporting. But interestingly enough, that has been, the only main target of the simplification. On top of that, actually, most of these rules, or big part of it, have not yet even had a chance to be implemented or bed in. So in reality, maybe indeed they could have been, simpler or simplified. But I think, even as the usual traditional lobbies have been calling for, is like usually you need several years to assess actually the impact of the rules before changing them. But indeed, I think that probably deserves another proper discussion. Now, going towards the end of our conversation, what are the key messages you would like our listeners, including EU policymakers and national policymakers, regulators, as well as market participants and other stakeholders, to take away from this conversation today?
I would start by saying that to protect and develop prosperity long term, we must face the reality of climate change and act accordingly. Sustainable finance strengthens economic and financial resilience, growth, and competitiveness. It mobilizes finance for a just transition to a low-carbon, sustainable economy. Only focusing on short-term costs ignores its long-term benefits. Investment integrating sustainability consideration tends to perform and be more resilient. At this moment in time, where the focus is on Europe resilience, competitiveness, and independence in a very challenging global geopolitical environment, everyone should understand that the only path for Europe to be resilient and independent is through energy independence. Through investing into renewable energy infrastructure, for instance, rather than relying on the dependencies of importing fossil energy like Russian gas or American oil. We can regret that through the Omnibus, the EU has watered down its transition ambition. But it's not too late. And it's important that European wake up, both at businesses, citizens, and political level, and realize the increasing importance of energy independence and focus on the source of energy, which is based in Europe, renewable energy.
Maybe I can add to that same question. First of all, I appreciate very much what Nathalie just shared about the energy transition and that it's not too late. The biggest theme that we're looking at as a firm this year around sustainability is on sovereignty. That touches a bit of what Nathalie said, which is how can Europe develop its own autonomy given what's happening in geopolitics? That's often talked about with defense industry, but it extends to energy. It's also about healthcare, technology. So there's a lot of areas around this idea of leadership that Europe should be considering that touches sovereignty. So policymakers, what they should take away from this conversation is that as part of that sovereignty autonomy, that agenda that I've seen very deeply discussed at EU level, sustainability needs to be part of it. The leadership that Europe has in sustainability should not be taken for granted. It's looked at by other parts of the world as a way to look at and understand leadership and then to adapt it to their local jurisdictions. I see it in Asia and many discussions I have with regulators. The US, we have to consider an outlier at this point about what's happening there. And if we look at other parts of the globe, there's more consistency tailored to sustainability that is in line with what Europe is doing as a leader. And so I want policymakers to not lose that leadership position, even if they're looking to simplify and consider the competitiveness agenda that they're facing.
I would add that EU sustainable finance rules are starting to deliver, steering financing to the just transition and helping companies to attract capital and manage risk. The rules may need some adjustment, for instance, to align concept definition, but their overall ambition should be maintained, preserving and enhancing stable, credible, sustainable finance rules to finance the required transition, to make Europe more resilient, more sovereign, more independent, more competitive. So in that context, sustainable finance is a strategic asset for Europe's economic future.
Thank you so much, Nathalie and Matt. It has been very enriching and interesting conversation. So once again, thank you so much for your time today. And we are looking forward to continuing the conversation maybe on Omnibus another time.